What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at shares of Amazon, where they're trading at today, and see if it's a good time for investors to dive in. All values that you'll see within this video are as of market close on April 13th, 2026. And as always, this video is not investment or financial advice and is solely for entertainment purposes. What we have right here is the past 12-month price chart of Amazon shares. And you can see that within that time frame, investors received just shy of a 30% return. And the bulk of that return actually coming from the right side of the graph, which is late March 2026, early April of 2026. And that's because of a shareholder letter released by Andy Jassy, the CEO of Amazon, that we will touch on later on in this video. But I think it's also important to put in the 2-year price chart for Amazon shares. And you can see that in that time frame, investors received actually a lower return. Shares have actually lagged all major indices in the US, that is being the S&P 500, the Dow Jones, and the Nasdaq indexes. Now, again, it's essentially a flat return when you look at it from January 2025 to April 13th market close of 2026. So there may be a catch-up trade in shares of Amazon, and it obviously has significantly lagged all of its Mag 7 peers. A few key items here to take a look at. There are 65 analysts who cover Amazon. They have a price target of $280.77. That does imply an almost 17% return from where shares closed on April 13th. You can see earnings per share growth kind of stagnating through 25 and 26, but you can see a big earnings per share growth through 2027, and they'll be able in 2027 to realize a lot of their capex that we'll touch on later on in this video. Over the past 12 months, sales have actually grown in Amazon 12.4%. They have come down, and you can see that 10-year trend, but overall the business is growing much greater than its industry and the benchmark as well. Now, fundamentally, the business is growing greater than the benchmark, yet shares have lagged the benchmark over a 1, 2, 3, and 5-year period. Gross margins for Amazon are actually 50.3%, and you can see a nice 10-year trend, and it's going to continue to trend as projected by analysts and Amazon itself in the coming years. Now, Amazon, you can see from that gross margin to net margin, has some accounting practices, whether that's carrying forward many of the losses through the 90s and early 2000s, and also accelerated depreciation of a lot of its capex infrastructure investments, such as data centers, chips, CPUs, and so forth. And in doing that, it kind of screws with the PE ratios. And I'll touch on that a little bit later on. I'll show a snippet, but even the forward PE of 29.2 actually does imply a fair value for a company that is growing and has projected growth that is much higher than the industry and benchmarks as well. And I just want to point your attention here. This is the ranges that the price target set by the analyst. You can see the most bullish analyst has a price target of $360. That is almost a 50% return. And the biggest bear of Amazon has a $175 price target, which does imply a 27% decline from where shares are currently trading. But on average, there's a 17% upside in the name that analysts on average agree with. And this is what I was talking about, where you can see certain accounting practices skew different numbers. And you just look at that first row there, which is the trailing PE. Currently, it's trading at 33.4, but a 5-year high of 348 and a 5-year low of 27.7. So you can see some major swings, and both the forward and trailing PEs are trading in line. In fact, the forward PE is trading well below its 5-year average. Price to sales is indicating a little bit expensive, but again, that premium, I believe, is warranted just due to the projected an accelerated growth in the various segments of Amazon. And you can see those segments here, which in blue is the online services, the green is the third-party seller services, the purple is the Amazon Web Services, the yellow is the ad business, gray is subscription, blue is the physical stores, and the turquoise is other, whether that is their Leo business, whether that's their Prime Video service, and their humanoid robot segment. Again, we'll touch on later on in this video. But those green dots I want to point your attention to, and that's the growth that actually occurred within those segments year over year. And you can see, and this is what we want to see as investors in great companies, is that the projected growth in high margin and high revenue segments. And Amazon Web Services, the cloud computing business of Amazon, saw a nearly 25% growth year over year and is projected to continue to grow. That is a very high margin business. And an even higher margin business is the ad business. And that has very high margins. You look at Meta, for example, which is the advertising king, and they have a 90+% profit margin on its ad business. So these can be cash flow juggernauts that are so small and small segments of Amazon currently. And what we also like to see is that gray bar there, which is the subscription revenue, which has grown and is projected to continue to grow, which gives Amazon a steady revenue growth year over year, whether that is the Prime subscription and other various subscriptions, like let's say the Leo service, which we will touch on here. But I want to mention, and I think this is actually a very good snippet for everyone to see, most of Amazon's revenue does come from the United States. There has been growth, and there's actually been a decline, and you can see that year over year, a 50 basis point decline in revenue percentage coming from the United States. And you can see a lot of growth in Europe and the Asian regions, and we want to continue to see that growth, as right now there's still a lot of growth to be happening in the US and in Canada. Right now, Amazon only makes up 37%. They are the largest market share holder of the e-commerce space. But again, that's 37%, which leaves a large runway of growth opportunity for Amazon just in the US and Canadian markets. But if we can get that boost in international and developing markets, and having those lower labor costs in certain regions can expand margins for Amazon, which will in turn benefit shareholders. Now, this whole video I mentioned about Andy Jassy's letter to shareholders, and in that 1 and 2 year chart of the share price, I mentioned that in late of March of 2026 into early April, you can see a share appreciation. And that was a lot of bullishness in this letter that I want to touch on here. And a few important points are the humanoid and robotics integration we'll start with. And it was reported that Amazon has over 1 million of these robots operating in its fulfillment centers. What they do is they're improving margins and delivery speeds by automating mundane tasks like sorting and packaging so that more deliveries can get out to Amazon customers. And in March of 2026, Amazon actually acquired a startup called Fauna Robotics. Now, what they do is they have a Sprout robot. And what Sprout is a 3.5-foot robot designed to, as the company states, perform home tasks and companionship. Not entirely sure what that companionship entails. Home tasks, kind of got an idea on that. But unlike Amazon's massive industrial warehouse robots, Sprout is a very compact, modular robot that's built to operate safely around people. You know, I can vibe with that. We don't want to have any Terminators running around. So this is a very untapped market for Amazon that can challenge Tesla and be a good growth runway that previous quarters was actually slated to close. Actually, in 2025, I believe, the end of 2025, Amazon's management in its robotics division actually was indicating that they may have to close down because they don't see any further growth. But a lot of these acquisitions and this in-house design and development that Amazon's been allocating towards its humanoid and robotic divisions has started to spark interest for future growth of this segment. Now, what was quite surprising to me was Amazon, the second largest grocer in the United States, they reached over $150 billion in revenue in 2025, with perishable sales growing 40 times since early 2025. That's insane. And this is important when it comes to that international growth as well that we looked at. We can take Costco as an example. We looked at in the previous video that in Canada, which was Costco's first branch out to the international markets, face a lot of scrutiny and execution risks. But as of 2025, like we noted, Costco was Canada's number one grocer. And if Amazon can develop and execute on this in many of these international and developed markets that it's growing in, and we see that in Europe, we see that in Asia, we see that in India, and so forth, that could be a good revenue boost. But this is the grocery segment, let's not kid ourselves, is a very low margin business. So it may boost revenue, but it may not be as big of a boost to profitability. But that is quite a feat, I will say, to become the second largest grocer in the US when there has been grocers doing this for decades and decades and have lost market share to Amazon over the past 5 years. And I mentioned Leo, and for those of you who don't know, Amazon's Leo is a low Earth orbit satellite network, which is actually the third largest in its operation. It actually aims to compete with Starlink by offering faster speeds, lower costs, and seamless integration with AWS. This can be a big business. They're not monetizing any of the capex right now, but in years to come, this could challenge AT&T, Verizon, T-Mobile, Comcast, and more, which is quite remarkable considering Amazon started as a bookstore. Let's not forget that. And we're only 3 years into Amazon's AI wave, but AWS's AI revenue run rate is over $15 billion. And to put that into perspective, that's 260 times larger than AWS was at the same 3 year mark in its history. Now, Jassy called out return on invested capital becoming attractive on AI infrastructure investments within a couple years of implementation, while adding that for investments being made in 2026, much of those would drive real returns in 27 and 28, with a substantial portion of it already having customer commitment. And what he also added was on top of the AI commitment of over $100 billion, there are several other customer commitments and agreements which are completed but are unannounced or deep in process. And this is encouraging. And the market kind of initially would reward people for having OpenAI contracts, but as of late, they have actually hammered them. And I think that it's quite funny that Andy Jassy had to make this comment to shareholders just to say, hey, OpenAI isn't our only customer on the street, and we have these other massive deals if, for whatever reason, that OpenAI deal falls through. That's not what Andy Jassy is saying, but I can read between the lines and believe that's what he's implying. Now, AWS is seeing such high demand, and this is crazy, that it would be growing even faster if it had more capacity. In 2025 alone, we'll use this as an example, Amazon added 3.9 gigawatts of power capacity, and they're planning to double that by 2027. And we can see how these constraints affect earnings as Microsoft's Azure business that we looked at in a previous video that did have supply issues different than AWS, which is having power issues. Azure had supply constraints and they had to divert a lot of their revenue internally, which means that they weren't able to monetize and capitalize on external growth. And we don't want to see that in AWS either. And this is important because Jassy explained that AWS typically monetizes its investments between 6 to 24 months after the initial cash outlay, which does suggest a massive wave of revenue is expected in the coming years because of the massive capex AWS has been doing through 24, 25, and 26. So fixing the power constraint allows AWS to spread its wings and have the anticipated return on invested capital that Andy Jassy has mentioned. And the last thing that I want to mention is AWS is actually indicating that its current revenues running on its custom chips stands at $20 billion of annualized revenue. But if the same chips were being fully monetized on the open market, it would be a $50 billion business with a B. And that's insane to think about. And this is just a segment, by the way, guys, of AWS and Amazon as a whole. And these chips are useful for data centers, other servers, and networking devices. But the data centers have a lifespan of 30 years, and the servers and these chips and these networking devices have a 5 to 6 year lifespan. But these timeframes continue to change. And in my view, given the likely direction of future latency requirements of AI developments and how much more and growth you look at AI, what it can do in 2022, and we look at it today in 2026, it has developed tremendously, which does need more power and more memory, which these Tranium chips actually deliver on, which is, again, insane. This is just a segment of Amazon. And Tranium 2 is largely sold out, and Tranium 3 is nearly fully subscribed, and a significant portion of Tranium is already reserved, even though it's still 18 months away. Again, people are wanting to line up, people in this case, large companies that are willing to wait for these Tranium chips. So you might know Amazon as the delivery service that delivers a package in no time to your front door, but they have these multiple different segments that they're able to monetize not just today, but long term. So I do believe, just based on these comments that Andy Jassy delivered to shareholders, are a bullish indicator long term. Again, this is not investment or financial advice, solely for entertainment purposes. Thank you so much, guys, for making it to the end of the video. Please do hit that like and subscribe button. It does mean a lot to me. And stay tuned for the next video.